Hey guys, Veteran here, Independent Traders Guild, ITG, and happy Saturday to everyone. Wanted to go through and show you kind of how I build a SPX chart for the upcoming week. You can see the chart is completely daily chart, SPX, completely empty. I do have some levels in here. I've already drawn them. I'm just going to highlight them as I talk through it. But one thing I want to go back is if you go back to say last July or 2 years ago, we're going back to August of 20. You can see that really from October we had that huge drop down. From November of 20 all the way to September of 21, we were in this raging up channel, and this was the buy the dip world retail. Learn to trade in this mode, and you can see how easy and smooth it was. And then September of 21 hit, and we retraced September to October, and then we launched again, retrace, and set an all-time high in January, the high of the year. And then from then, with rates, bonds, the US dollar, inflation, you can see how violent this year's been. So if you're struggling this year and your comparison is to this channel, well, duh. I mean, you should be. This is, guys, I mean, this is like shooting layups on a 4-foot goal, basketball goal. I mean, this is not, you'll never have this again in your life, in my opinion. This is not a normal market. I think I've seen it 3 times since the 1980s, early 1990s. Just doesn't happen often. So let's move on. So we've got a daily chart, SPX, and I'm going to zoom out. And a couple things need to stand out. The first things you need to do. The first, you need to go back and you need to look at the high of the year and we're looking for lower high, lower lows, peak, peak, peak. This used to be the trend line. I might can draw this real quick. This used to be the trend line, here to here. But as soon as we came up and spiked that's how we knew how high we were going in August. Why trend lines are important. Okay, we just drew it to here. None of this existed. Now the trend line is no longer from here to here. Now the trend line goes from here to here. And if that wick through it a little bit, it doesn't matter. This is your, that's your point. This is now your new point of inflection. And then you go back to COVID lows, to the current low of year. So 2020 lows to 2022 lows. This is where we currently are operating. And so now we have a nice little wedge formed here. And the market's going to trade into this wedge until it breaks out to the upside or until it breaks down to the downside. We'll let you know. From there, I've got my gravity points. Top gravity point, 40.90. Mid gravity point, 39.75. Lower gravity point, 38.25. If you're not an ITG member, you don't have those. You got them now. If this goes Twitter, YouTube, better get them. Put them on your chart, because they matter. So gravity point 3, gravity point 2, gravity point 1, and then the low of year. So I'm going to move these over. I'm going to move these over, get them out of the way. 38.25. I didn't mean to draw them. I should lock them. I can't lock them. I can't move them. I'm a veteran with the markets, not with technology. I'm a boomer. My guys are laughing. I know they are. They laugh at me. So then what do we do? Well, then now we go to Fibonacci's. Fibonacci's become important. OCD. Sorry about that. Fibonacci's become important. So the first one is we want to do a Fibonacci from the high of the year to the low of the year, just like a trend line. So that's this one. Okay, I've got it set up over to the left side. There's a little bit of background in there, a little bit of color. The important thing is for you guys to be able to see the levels, because the levels matter. Okay, we know we're not going below the low of year, and we're gonna zoom this in a little bit. And then you got to look in from the second swing high, most recent swing high. What's important? You guys go swing high to swing low. And if you drew Fibonacci's during this point, or if you drew Fibonacci's from the high of the year to this low when we put it in, it would give you levels that the market would be expecting to retrace. Typically, a retracement from the high to the low, a typical retracement is the 0.5 to the 618. Well, 0.5 right now is 41.55. From the high of year, all-time highs, to the low of the year, a typical retracement in a healthy market would be 0.5 to 618. We're going to go through and retrade this zone somewhere in the future, but not right now, I don't think. Okay, then you go to draw Fibonacci from the most recent swing high to the most recent swing low, which also happens to be the low of year. And that one is going to come out as here. Now, what's important now as we start getting into this is to see areas of confluence. Okay, so from August high to October lows, typical retracement is 0.5, 39.08. Look at what we almost got to Friday. 0.5 to the 618, and the 618 goes up to 40.60. Then you always, Pika, SL, all of us make these comments, but always look left. Most recent fibs are over here, looking left to the latter fibs to this zone, and you can see confluence in here. Okay, here you've got two fib levels and the lower gravity point. Becomes super important. The last thing I do, again, I'm doing this on SPX for the masses, but then the last thing I do is I go and I'll pull up our weekly supply and demand gaps. Okay, supply is where there's an excess of buyers on the white line, and each grouping is for an entire week. And I'm going to go down to 4 hours in a second, but I just wanted to show people. Actually, I'm going to go to 4 hours now. I just want to show people where you can look through and see the white channels. They're a different distance apart each week. They're not the same distance. But where you're looking for is, look during this period in June where we traded in a balance area and all the white lines. 1 week, boom, spike down, got back into it. 1 week, 1 week, 1 week, 1 week, and then boom, impulse move up. So this is range, trend, range. We found balance up here. Not here, but we found balance in this zone, these two. The next week, these two. The next week we spiked up. The next week we came back into it. Next week we spiked down, got even lower. Then we got back to that balance, and then we, boom, impulse moved down, and now we found another range. So right now, there's a range down here. There's balance down here. So somewhere in this zone, underneath this 0.236 fib level, 36.88, down to that upper trend line coming up from the lows of the year, somewhere in this zone is where the market's going to find a balance, and you'll find buyers. Now, October, big month, best month on the stock market's history for the Dow Jones. What's crazy, and I just did this for the preview, if you go back on a daily chart all the way back to the 1st of October, you'll find we have 10 green days and 10 red days. So even though everybody's screaming about the great returns of October, well, they're great returns off of that freaking low, October 13th. Friday was big, but October 13th off the lows, as we put in the lows, and we talked about certainly in ITG that the lows of the year would come on a spike down, but we'd be back well above the lows of the year, the previous lows of the year in no time, and we took it back almost the same day. So as you go through here, guys, this just gives you an idea. So then what I typically would do is I would go and look, and I'd be like, okay, what are the areas of confluence? Gravity point to gravity point. Okay, we've got 0.5 to 618. So we know 618 is likely. Healthy market, healthy retracement from August highs to October lows. We could hit the 618, roll back over. So 618 gives us a good number at 4006. Then we also have this fib level here from the all-time highs. Tons of confluence, and we have a gravity zone, gravity point right here. And that's the mid-gravity point. And then we look to the left and we see, again, we had balance up here. We spiked down. We got a little bit lower. We spiked back up. In here, are there any gaps in here? As we went from here, there's a gap from here down to here that we never filled on the white zones. So I would draw a line. I would draw a level at this demand zone, which is where we have buyers, to this supply zone. I would draw a level. I would draw a box in those two zones. Oh man, click the mouse bed. Click the mouse. I don't need it to be. I would draw a zone in here, and again, I'm not going to. Again, that's not how I do just the supply demand on the ES, but it does give you an idea of this week. If we can get above the 0.5 retracement tool, we already got above. You see over here with the gravity point, lower gravity point, you'll see we dropped through it here on the 21st of September. We dropped through it. We never came back to retest it. Okay, we got through it. We got lower. We came back up and we kissed the channel early October. We kissed the channel, fib level from highs, fib level from August, which is the 382, and we never got to the gravity point. So we hit it this week on Tuesday, and you can see we hit it. Then we got back down to it. So we hit it Tuesday, we hit it Wednesday, we hit it Thursday, and we hit it again Friday. We hit it 4 or 5 days this week. Now we're going to see if we're going to get price acceptance. If we get price acceptance above this gravity point, I would imagine that we could extend above the 0.5 this week, 3908, and we could get into this zone. The next gravity point, the next Fibonacci from the all-time highs, the next Fibonacci from the August highs, and this is a zone gap right here in supply and demand on SPX. So that's how I would kind of start to word it out. So then I'd go to a vertical line, and I'd be like, okay, where's Friday? Friday is November 4th. So I'm going to go to November 4th, and I'm going to draw a line. And then as we look through this line, can we get here by Friday? Absolutely. And then what's my all-time high? My biggest fear. Well, the downtrend line from all-time highs, high a year, intersects with the 0.78 from August, and that would be the 618 from all-time highs. And so this intersection becomes potentially, this right here should be the absolute highs of the week. Shouldn't get any higher than that. Like, super, super, super doubtful. And that would be, peace in Ukraine. That would be, Bank of England solved the pension problems. Bank of Japan is, they figured a way out without having to raise rates. Inflation drops. FOMC comes in and the Fed pivots and say, you know what, we're gonna hold. We're gonna go 0.5 in November, and we're gonna hold the rates there until January. I mean, for us to get up there would be, you'd have to have all the perfect things in the world happen. Realistically, this is what we're going to be looking for. I would imagine this is not PVI, guys. PVI data is going to come in where it's going to come in, but I would imagine the PVI is going to be somewhere around that upper gravity point at 4090 on SPX. The number will be higher because again, PVI is designed to let you guys sell credit and not necessarily clinch. I would tell you anything above 4146 on weekly range for SPX is going to be safe, selling premium. This is going to be the ballpark of where we're going to trade this week if the market moves to the upside. If the market moves to right here and we reject the 0.5 and we start to roll over, well, here's November 4th. How far can we fall November 4th? Well, we just came from here last Friday, the 21st of October. So we could definitely give back last week's gains, right? We opened here on Friday. We closed here on Friday the 21st. Um, I mean, we can easily go back to here. Here's a trend line here. I would look at supply and demand, and guys, you know, we hit supply. This is supply, sellers. The next week, this was demand, buyers. The next week, this was demand, sellers. We never fell into this zone. Okay, this was a zone that was created. There are not many that get created and don't get run through. Even this last week, we pushed through this on Monday. We didn't touch this supply demand zone. We didn't really touch this supply demand zone. There's a wick right here on Monday, the October 3rd. There's a wick afterwards. This was after. This was the next week. We have two supply demand zones down here at the low of the year that were never tested. Well, supply demand zones. There are a lot of people that were ready to sell here. There were a lot of people that were ready to buy here. Those didn't get tested 2 weeks in a row, or 2 out of 3 weeks. That's probably be the ultimate bottom. This line down here, Friday, going out to Friday, the line intersects November 4th from the COVID lows, 35.24 on SPX. So that would realistically be the absolute lows of this week. I would be willing to bet that most PVI models, most weekly predictions, are going to be somewhere north of 36.10. That we're not going to drop below 36.10 this week. So that just kind of gives you an idea as we start to formulate the ranges. You're looking at November 4th. You're looking at trend line from the yearly highs on down. Your all-time highs on down. You're looking at COVID lows on up. And we're starting to bracket this area. You've got a gravity point, a gravity point, a gravity point, all within this wedge. And we've moved higher. Are we going to pull back and range here and form a range here? We could. Are we going to move a little bit higher and form a range here? We could. Could it impulse back down and we get back down into this area of balance? Very likely. And so more than likely, as I put, this is the expected immediate upside. I would clone this, and I would pull this down, and I'm going to go over here and look, and I'd find the supply demand zone, and more than likely, and I got to change them. You'll see the width of the supply demand zones. They're all different each week, but more than likely the supply would be between here and here, this gap, the immediate downside, and that straddles a Fibonacci level from August highs. So immediate upside, immediate downside with a fib, immediate upside with a fib, a big one, 618, the golden fib, and a gravity point, and a fib from the higher year. This is super likely. I'd be looking for a move up into here to potentially get back down to 38.25. And if there's really, really bad news, we'd go right through it. It'd be a yeller down to a yeller, and we could get down to the 236, which would be 36.80. So I venture to say this is going to be the average range for the week. This would be the extreme. This would be the extreme. The extremes are supported by trend line from the high of year, trend line from the low of the year. Everything's starting to look real good in here. For us to get up here, volatility is going to be, VIX is going to be sub 20. For us to get down here, VIX is going to be in the upper 30s, 36, 37, 38. Again, PVI gives me those numbers and data. I don't formulate them, but I want to give you all an idea of kind of how we do it. We started from nothing, trend lines, gravity points, Fibonacci from the highs, Fibonacci from the swing low, and then start building out some supply and demand zones. Where is the market likely to go? Is there confluence at these zones? If there is, start putting them on your chart and trade with confidence. A veteran here, Independent Traders Guild. You guys have a wonderful weekend. God bless.